Welcome to Pip Insight Macro, the economic calendar briefing for the daily Forex news. Today is the 16th of July, 2026. This session has 1 high impact and 5 medium impact releases coming up. Let's run through exactly what's on the calendar and what it means for the major currency pairs. Welcome back to Pip Insight Macro. I'm your host for today's daily Forex news. We've got a packed agenda with 5 medium impact events, but all eyes are on the UK right now. British GDP is dropping at 2 AM Universal Time Coordinated, and that's our headline story today. We'll break down what it means for sterling and walk you through every major event hitting the market. Let's get started. Here is the full economic calendar for the daily Forex news. We have 1 high impact releases due this session. Let me walk you through each key event and what it could mean for the markets. We're looking at the UK GDP month-on-month reading, which is a high-impact data release that just hit the wires. This measures the monthly change in British economic output, and today's print could significantly shift sentiment around the pound. With forecasts calling for zero growth after a previous contraction, this one's a real make-or-break moment for sterling. GDP month-on-month is one of the most direct measures of economic momentum. It tells us whether the British economy is expanding or contracting on a month-to-month basis. This matters enormously to the Bank of England because consistent growth or contraction directly influences their interest rate decisions, and rate expectations are ultimately what drive currency valuations. The forecast is sitting at 0%, flat growth, which comes after last month's negative 0.1%. Here's what traders need to understand: if we get a beat and see positive growth, that's genuinely constructive for the pound because it signals the economy is accelerating despite recent headwinds. A miss below zero would be particularly damaging because it extends the contraction narrative and could prompt fresh dovish repricing for the BOE. Even a flat print matching the 0% forecast might be seen as a modest negative given expectations were for stabilization. Watch for the reaction in the first 5 minutes post-release, particularly around support and resistance levels, because GDP data tends to create sharp directional moves as market participants immediately repriced rate odds. Pound-dollar is your primary pair to watch here. A strong GDP beat could push cable higher as investors recalibrate BOE rate expectations upward, while a miss sends it lower. Euro-pound is equally critical because Eurozone growth comparisons matter. If UK growth disappoints relative to recent ECB messaging, we could see that cross move significantly higher against sterling. We're looking at core retail sales month-over-month data coming in, and this is a key indicator of consumer spending momentum without the volatility of food and energy prices. Today's print is particularly important because it gives us real insight into whether American consumers are still opening their wallets despite higher interest rates. The forecast is calling for a flat 0% reading, compared to the previous month's stronger 0.8% growth, so we're expecting a notable slowdown here. If we see a beat and retail sales come in hotter than expected, that's actually US dollar positive because it signals economic resilience, which typically strengthens the dollar. On the flip side, a significant miss below forecast would suggest consumer demand is cooling faster than anticipated, which could weaken the dollar as markets recalibrate their growth and rate expectations. The currency reaction tends to be sharp on this data because retail sales account for about a third of consumer spending, making it one of the Fed's most closely watched indicators. Euro-dollar and pound-dollar will be your most reactive pairs on a surprise move, with a strong retail beat sending these pairs lower as the dollar strengthens. Dollar-yen and dollar-Swissy, our safe haven crosses, typically move in the opposite direction, with weakness in retail sales supporting buying in those pairs as investors rotate into defensive currencies. We're looking at the Philadelphia Federal Reserve Manufacturing Index, a key regional gauge of factory activity in the Northeast that often signals broader US economic health. This is a medium impact release that traders watch closely because strong manufacturing data typically strengthens the US dollar across major pairs. Today's forecast of 12.7 comes in higher than the previous reading of 10.3, which would signal accelerating manufacturing momentum in the region. If we see a beat on this number, expect US dollar strength across the board as it reinforces the narrative of resilient American economic growth and potentially supports the case for sticky interest rates. A miss, conversely, could suggest manufacturing weakness is spreading, which would weaken the dollar as traders reassess the health of the US economy. The immediate reaction typically manifests within the first hour of the release, with momentum traders piling in quickly on directional conviction. Euro dollar and pound dollar will be the most sensitive to this data, with a strong beat likely pushing these pairs lower as the dollar appreciates. Dollar yen and dollar Swissy will also move meaningfully, though they tend to be more reactive to broader risk sentiment than pure manufacturing data alone. We're looking at US retail sales month-on-month data today, which measures how much consumers spent in stores and online. This is a crucial gauge of consumer health and economic momentum, and it directly impacts how the Federal Reserve thinks about interest rates and inflation. Retail sales came in at 0.2% versus a forecast of 0.2%, down significantly from the previous month's 0.9% print. A miss here would suggest consumer spending is cooling, which could ease inflation pressures but also signal economic slowdown that's generally dollar negative as it reduces Fed tightening expectations. A beat would reinforce consumer strength and support the dollar on hopes for sustained rate hikes. Euro dollar and pound dollar tend to see the sharpest reactions because these pairs are most sensitive to US-Europe interest rate differentials, while dollar yen and dollar Swissy respond to shifts in safe haven demand and Fed policy outlook. Euro dollar and pound dollar are your most exposed pairs here, with a weak retail print likely pushing these majors higher as the dollar weakens. Dollar yen and dollar Swissy will also move, but their direction depends more on broader risk sentiment and whether weak retail data triggers a flight to safety trade. We're looking at initial jobless claims data today, which measures how many Americans filed for unemployment benefits last week. This is one of the most watched economic indicators because it gives us a real-time pulse on labor market health and directly influences Fed policy decisions. If claims come in hotter than the forecast of 216,000, it signals potential labor market weakness, which typically weakens the dollar as markets price in a more dovish federation. A beat, or lower claims number, supports dollar strength by reinforcing that employment remains resilient. The magnitude of the surprise matters significantly here. Even small misses can trigger meaningful moves because this data comes weekly and trends are closely monitored. We should expect the most volatility in dollar pairs immediately after the release, with carry trades and risk sentiment also playing a secondary role depending on the broader market mood. Euro dollar and pound dollar will see the heaviest action as risk sentiment swings, while dollar yen and dollar Swissy, the traditional safe haven pairs, may move inversely if the data signals economic concern. A weaker than expected jobs picture typically brings dollar selling across the board, benefiting euro and British pound against the greenback. We're tracking comments from President Trump today, which carries medium-level impact for currency markets. Presidential remarks can shift sentiment around US policy, trade, and economic direction, so traders are watching closely for any signals that might move the dollar. When a sitting president speaks, markets react to the asterisk tone and content asterisk of those remarks rather than a traditional beat or miss. If Trump signals a stronger dollar stance, pro-growth policies, or hawkish trade positions, we typically see the dollar strengthen across the board. Conversely, dovish comments or uncertainty around policy could weaken the greenback. The key is watching for any shifts in sentiment that might alter expectations around Fed policy or US economic resilience. Volatility tends to spike in the minutes following the speech, with positioning flowing toward or away from US dollar-based pairs. Euro dollar and pound dollar are your most sensitive pairs. They tend to move inversely when dollar sentiment shifts. Dollar yen and dollar Swissy will also respond, though they're often influenced by risk appetite. If Trump comments spark risk-off moves, safe haven currencies like the yen and franc could compete with the dollar for flows. We've got UK construction output coming in this session, a monthly gauge that measures activity in Britain's construction sector. While marked as low impact, it's still worth monitoring as it feeds into the broader picture of economic health across the pound. We're looking for a decline of 0.3% month on month, compared to the previous reading of plus 0.1%. A contraction here would suggest some slowdown in construction activity, though the market typically responds mildly to this data point. British pound pairs may see modest volatility, but major directional moves are unlikely unless the print significantly surprises expectations. Pound dollar is traditionally the most responsive pair to UK economic data, so that's the one to watch for any initial pound reaction. The UK goods trade balance is out today, measuring the difference between British exports and imports of physical goods. This is a key indicator of trade health and economic competitiveness for sterling. We're expecting a deficit of £23.1 billion, which would actually be an improvement from the previous £26.0 billion deficit. While this shows some stabilization in trade flows, the overall low impact rating means we shouldn't expect dramatic market moves. The pound may see modest support if traders view this as progress, but don't expect major volatility from this release. Pound dollar is typically the most responsive to sterling data, though all the major British pound pairs could see minor fluctuations depending on the broader market context. We've got the UK Index of Services coming in today, which measures growth across the services sector, the largest part of the British economy. With a low impact rating, we don't expect major fireworks, but it's still worth monitoring for subtle pound movement. The forecast is calling for a slowdown to 0.6% on a 3-month basis, down from the previous 0.8%. This suggests the services sector may be losing a bit of momentum, which could weigh slightly on sterling if the data comes in as expected. Given the low impact classification, any reaction should be measured and relatively quick to fade. Pound dollar will likely be your most responsive pair, as it's the primary outlet for pound-specific data releases. We're looking at the UK industrial production month-on-month figure, which measures the change in output from British factories and manufacturers. This is a key gauge of economic health, though today's release is expected to have only a modest impact on sterling. The forecast is calling for a slight contraction of negative 0.1% compared to the previous flat reading of 0%. While this suggests a minor slowdown in industrial activity, the low impact rating means we shouldn't expect dramatic swings in the pound. That said, any deviation from this forecast could still spark some movement, particularly if we see a larger than expected decline. Pound dollar is typically the most responsive to UK economic data, making it the pair worth watching most closely during this release. Based on today's releases, the pairs most at risk of volatility this session are pound dollar and euro pound and pound yen. Here is a breakdown of why each pair is in focus. That wraps up the complete daily Forex News economic calendar breakdown. The key theme today is UK GDP focus drives sterling volatility today. Keep a close eye on the release times. A surprise deviation from forecast is often where the real moves happen. This is educational content only. Trade safely and manage your risk. That's your Forex landscape for today. If you found this helpful, please like and subscribe for daily market updates. Connect with us on X at @ForexInsight. Thanks for watching Pip Insight Macro.